Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The main event for markets this week will be the Fed's rate decision, and the only debate seems to be over whether an expected cut will be either 25 or 50 basis points. Importantly for markets, the focus will be on messaging with regard to future rate cuts. And in addition to the Fed, we have rate decisions this week for central banks in Canada, the UK, and in Japan. And in a moment, we'll have some insight from Singapore. We'll hear from Louise Loo, lead economist at Oxford Economics. But we begin here in the States. Joining me now is Adam Coons. He is the chief investment officer at Winthrop Capital Management. Adam is on the line from Indianapolis. Adam, thank you so much for making time to chat with me. Can we begin with the Fed's decision this week? I think the only thing the market seems to be debating right now is whether this cut is going to be 25 basis points or 50 basis points. Where do you come down?
First off, we got to look at what the market, how it could react. And like you said, the market has kind of priced in the best case scenario. So I think really all that could happen that would move the markets would be some sort of disappointment. But I think, the Fed is going to probably move with a 25 basis point cut. I think a 50 basis point cut is very unlikely. While the data has started to tilt towards, being somewhat more negative, I just don't think there's enough to push the Fed towards cutting more aggressively than 25 basis point. I think, it needed to leave something in the holster down the road if we do see further deterioration. But I think moving that aggressively, like a 50 basis point cut, would just be too much right now.
So I'm curious to get your take on whether you believe stagflation is a risk at all. I mean, we know the labor market is weakening and inflation remains stubborn. We're well above the Fed's 2% target. Is stagflation a risk in your view?
I think, you could see the headlines and you could see maybe a print or so where it looks like there's stagflation. But ultimately, the old saying that the remedy for high prices are high prices. I think if we saw some kind of uptick in inflation, that would be very short-lived, because that essentially would accelerate this idea or thought that the U.S. economy is going to move towards a recession. Because if at the end of the day, the consumer only has so much they could spend. And when we look at, credit card debt, when we look at, all the levers that the consumer could pull, they kind of have pulled them all. And so I think if we saw some sort of increase in prices that was outpacing wages, the consumer essentially is tapped out. So that essentially would push us into a recession and would kind of solve it's kind of the worst case scenario solution for inflation. But I think it would lead us back towards a disinflation or potentially even a deflationary period.
It's interesting because at the end of last week, the University of Michigan released its preliminary survey on consumers' long-run inflation expectations at a rate of 3.9%. Households seem to be concerned about the consequence of tariffs. That's got to be a little concerning when you hear a number like 3.9.
Yeah, it does, but it really comes down to the fact that the consumer's concerned about a 3.9 is going to affect behavior, and that's really what we have to focus on. Is what is consumer behavior going to look like? And I think if we look at the reality of tariffs, it's hard for us to model tariffs pushing inflation towards 4%. What will likely happen is the consumer will be, fearful of a 4% inflation, might, cut back on spending, thinking that there may be something coming on the horizon they need to prepare for. And that in and of itself would actually cause that disinflation that I was speaking of. And I know that's backwards of what, the economic theory says. But when you look at the consumer and when you kind of do your own survey around and do the anecdotal survey of what consumers are thinking, how they're reacting. Consumers right now, like I said, inverse of what economic theory tells you they should do, is actually when they see or think or feel that inflation on the horizon, they're preparing and slowing down their spending. And so I think that the reality is the fear of tariffs might actually solve the inflation that they might cause in their own. So I think you're just going to see an overall deceleration from the consumer because of that fear.
Mm-hmm.
Because, like I said, obviously when you see the employment number starting to contract, employment generally is just weaker. Now, it's obviously not declining yet, but when you see the employment picture weakening, the consumer is also just going to be a little bit more cautious, and that in itself, like I said, will solve the problem of potential inflation.
So I know you're not a trader. Winthrop Capital is a money manager, from my understanding. But let's go ahead and think about the way in which the market may react on Wednesday when we get news of this Fed rate cut, which is probably more likely to be 25 basis points than 50. If it's 25, does the market sell the Fed news?
Well, I think it really comes down to how the Fed, how Jerome comes out and gives his kind of speak of what's next. I think 25 basis points with rhetoric that looks like they're going to continue to cut interest rates as long as the economy is showing the data signs that it is. If Jerome comes out and does a 25 basis point cut, but shows signs, or at least there's an interpretation that they may pause for the rest of the year, then I think that's when you see the stock market sell off. But as long as he at least demonstrates the willingness to continue to cut, I think that the markets will rally, or at least kind of have that unchanged mentality, given that's the general consensus estimation right now.
So we're not that far from record highs in the equity market right now, and I'm wondering whether that makes you a little bit nervous, given how far and how fast we have come with a lot of the risk that you're sketching out right now. Are you still constructive on the U.S. equity market, or are you starting to become maybe a little cautious?
More cautious, absolutely. I think, look, you can't time the market, nor should you try. I think valuations are something you should pay attention to, but once again, you shouldn't time the market based off of valuations. But you do need to pay attention to where we are. And I think when you look at the asymmetry of events, it's towards the downside, meaning that there are more things that could go wrong that could probably go right. And so when you see valuations, when you see the equity market essentially shrug off everything, and we kind of have completely undone everything from the drawdown that happened in March and April, like I said, we're at all-time highs. So we're seeing that. By no means is it a bubble. By no means is it this completely overextended market. But you have to pay attention. And like I said, what it really does is it eliminates the margin of error when you see valuations this high. So what that means is that if you do see maybe something like the AI trade start to fade, or misses on earnings estimates, then that's what's going to, there's just less margin of error for those kind of events, and less margin of error if the Fed actually takes a stance that the market doesn't like. So I think you just need to be a little bit cautious, but by no means do you need to be moving out of equity markets. I think you want to continue to ride the momentum, but you just need to do it more cautiously and like I said, more proactively taking chips off the table, moving towards dividend paying stocks, lower beta stocks, and just kind of watching for those stocks that are only going higher because of narrative versus actual fundamentals.
So you were talking a moment ago kind of about a defensive posture in terms of equity trading. I'm curious as to whether you're looking to the bond market for optionality, and if so, where on the curve are you finding value these days?
Yeah, we absolutely are. So I think you need to look kind of in the middle of the curve. That intermediate 5 to 10 year space, I think, is kind of the pocket to be in. You've obviously seen the short end come down as the bond market is essentially priced in anything the Fed's going to do. And then the long end of the curve is a little bit kind of in a guessing game. And you've seen some big moves up and down in rates on the long end, trying to understand not only what the Fed's going to do, because obviously the Fed's absolute decision doesn't affect the long end of the curve, but it could trickle into inflation and growth and that sort of thing. So you have seen rates come down. You obviously have the 10-year at that 4% type mark, and that is well off of its highs, near 4.5. And so I think when you're trying to play defense, you're trying to lock in some income. a little bit of spread. Like I said, the belly of the curve, 5 to 10 year, you kind of get that Goldilocks portion of fixed income where you get both the steepness of the curve now that we actually do have some steepness in the curve. We're not inverted any longer. And then, like I said, you do pick up in corporate bonds a little bit of spread. I think that makes sense to be able to get, 4.5 to 5%. Even though spreads are tight, I think to lock that in right now is critical. If you're a portfolio manager, you're looking at your asset allocation, to say that we're going to get 5%, there was a time not long ago that we were struggling to get 3% in bonds. So to get 5% in fixed income, I think you want to lock that in for as long as you can.
All right, Adam, we'll leave it there. Thank you so very much. Adam Coons is Chief Investment Officer at Winthrop Capital Management, joining from Indianapolis here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We've been talking about how monetary policy is front and center for markets this week. Among the rate decisions, we'll hear from the Fed and the BOJ. And for some more perspective, we heard from Louise Loo, lead economist at Oxford Economics. Louise spoke with Bloomberg TV host Shery and Annabelle Droulers on the Asia trade.
And Louise, thanks so much for joining us this morning. I mean, it's really a lot to contend with right now. Not only are we really influenced, of course, by these ongoing trade headlines, not just between US and China, Korea and the US, I mean, many other nations as well, conducting these negotiations ongoing. But at the same time, we're looking at the first Fed rate cut of 2025, a slew of central banks decisions this week as well. What's standing out to you the most right now? What's going to be most important for you this week?
Well, there are a lot of data points, a lot of things to follow this week. Well, first up today, we have the China data. I think the conclusion there seems to be that we should be looking at further weakness. That should set the stage quite nicely for further domestic easing by the Chinese authorities. And then further down the week, we have a number of central banks in Asia, that all of which we expect to stay on hold, all for different reasons. The Bank Indonesia one will be particularly interesting, just because of the domestic political pressure that we are seeing over the past week. With Fed easing, you would have thought, maybe a few months ago that this would have been an easy decision for them. But clearly, I think where most market analysts, including ourselves, are expecting is a hole in the meeting just because of the market volatility that they're contending with.
What about the Fed, though? I mean, as we said, it's expectation around the first Fed cut this year. I mean, how significant then is that going to be for the central banks in this region, especially when at the same time we're monitoring that yuan appreciation that is supporting a lot of emerging market currencies? Yeah,
that's right. So I think going into this first rate cut, this from the Fed, we are seeing a lot of negative rate differentials with a lot of the Asian central banks in the region. So that's contrary to what we see in the headline currencies. That has actually been a bit of an anchor for the currencies in the region. So to the extent that that the Fed is easing rates, that is actually positive news for a lot of central banks here who are in the coming months possibly having to contend with slowing growth, the fact that disinflation has been tapering off a little bit and plateauing at about 2%, 1.5%. Those are pretty low inflation prints, but central banks in the region are looking to be a little bit more dovish, to lean towards an easing bias to support the economy, given the trade uncertainties are finally settling in. So I think, the Fed cutting rates by 25 bips or perhaps even 50 bips, that would be pretty good news for the regional central banks.
But Louise, let's back out a little bit. Are we correct in assuming the Fed is now firmly on an easing path? Because markets are pricing in the fact that perhaps the focus will be much more on the jobs market slowing down. We still have inflation to contend with. So what happens after the first 25 basis point rate cut?
Yeah, I think the way we have characterized the Fed cutting cycle this time around is one of normalization rather than easing. You're right. The jobs report obviously is not comforting, but the jobs numbers that we see does imply that deterioration in trend job growth has been more gradual than we thought before. So that's positive news, as positive as you can pick from these numbers. And the fact that inflation inflation is not really on a very clear path towards 2%. I think that sort of dynamic is really forcing the Fed to be a little bit more cautious than maybe the outright 50 bips that some parts of the markets are expecting. So given that, I think the calculus is really towards the Fed moving rates very gradually towards neutral, which we think is about 3%, 3.1%, with that starting with that 25 bits that we were likely to see in September, and maybe perhaps another 25 in December.
And Louise, also very consequential when it comes to the global bond markets has been the Bank of Japan as well, especially with JGB yields in the long end surging. What are we expecting in this week's decision, and when could we expect the first rate hike?
Yeah, well, so in the case of Bank of Japan, the calculus there is really whether or not economic activity is going to be strong enough. We have seen some signs of reflation in recent quarters, so that's positive. But in general, we think that the peak tariff shock to the economy is going to come towards the second half of this year. So the Bank of Japan, in our view, is likely to stay put for a while. And our view, our Japan Economist view, is that the central bank will start hiking again only in the second half of next year.
What does that mean for the Japanese yen? I mean, Annabelle just brought up the yuan's anchoring role when it comes to emerging markets, but the Japanese yen has also been really range bound. And what does that mean for the other side of that trade with the US dollar as well?
I think the fact that given that the Fed is going to be cutting rates, rate differentials are in favor of the yuan. And so therefore, you should expect some appreciation bias in the quarters ahead. Now, having said that, I think there's a lot of volatility in the market to sieve through, to work through. So it may be the case that, the dollar might find its footing again towards the end of this year, next year, and that should, be a little bit of a boon for the economies, for the regional currencies out here in Asia.
Louise Loo, good to have you with us, lead economist at Oxford Economics.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.